This is Bob Roark with Business Leaders Podcast, and we're doing a continuation of the series with my co-host, Marla DiCarlo. She's the CEO and co-founder of Raincatcher, a business brokerage out of Denver, Colorado. And returning as guests, we have Allen Harvey and Jim Gilbert. In the previous episode, they were going through the details of the sale of a business that they ran together in Denver, a recent transaction last year. And Marla's company handled that transaction. But what I wanted to cover today with Jim and Allen and with Marla's help is to unpack the skill sets that both of these gentlemen bring to the table and their insights to the business owner mindset and skill sets and some of the levers and tools that they can have in place that will help them run their business. So we talked about this a lot before we started. And so first, I think we'll start alphabetically. So Allen, if you would, tell us a little bit about your business and who you serve.
So I'm an independent valuation expert, and I do professional certified business appraisals. We also work on calculations, which are not independent certified business appraisals. I work for IBVA, and IBVA Pros is the team that we put together with some other valuation experts. I'm teaming with a valuation expert by the name of Mike Dugan, who's got he's a veteran appraiser in the industry. And we are also developing some relationships and teams with other appraisers as well, so that we have a team approach to our appraisal practice. So that's what I do. We are at IBVA.com or IBVAPros.com.
Jim?
Sir, I'm a CPA, run a CPA consulting practice. We have three sides of our business. One side is the traditional accounting, bookkeeping, day-to-day, help many clients, cloud-based accounting. I've got the business side where I work on lots of CFO, controller, advisory business. And then the other side of our business, which is my passion, is technology and how do you apply technology. And I spent a lot of time working with, my greatest love is merger and acquisition. Spent a lot of time helping my owners, both buyer and seller, be successful in how to get through those processes and achieve maximum value on whether you're buying or selling.
Marla, and you and I are friends, and we've talked a lot, and we've had a number of episodes. And talk a little bit about what you do at Raincatcher, and then we'll try to weave together while we're all on this podcast together.
Sure. So Raincatcher, we help entrepreneurs to sell their companies and more importantly, to maximize the full value before they sell. So that's something we see owners aren't either aware that they're leaving money on the table or that they have options before they decide to sell their company. So we're here today because Jim and Allen are a big part of the affiliates that we use to help those owners make sure that they don't have seller's remorse. Maximize value. I think about great segue. Thank you for that. Because that's exactly why you're here. I think about the business owner and for so many of them, it's their life's work. They're extremely passionate. They know everything about that particular service or product that they have. But I think what they fail to do, or in many cases is difficult to do, is view their business from the buyer's perspective. And so, and there's the difference that we talked about previously between a job and a business. Yep. Value drivers in the business, all of these various topics. So, thinking about how do we start? So I think what we wanted to do as goals out of here is to share with the business owner 2 or 3 things maybe that they can take away from this podcast that they can deploy in their business that will, bring profits to the bottom line or increase the value as opposed to just cash flow. So who wants to start? Allen? Jim?
I think I'll start here. I think you're spot on there, Bob. And what the listeners here today need to understand is, if you're confused by where do I start, what's my company worth, where am I at in the process? Do I sell today? Do I sell 5 years from now, 2 years from now? There are people out there. I'd recommend that you find advisors. If you're a manufacturer and you're great at manufacturing, there's also the art of business and getting people, surrounding yourself with people that are great advisors, have great networks, have connections to all the facets of business. And how do we look at that? And how do I know how would a buyer look at me? What are the things that are attractive to a buyer? And having somebody that can advise you and work through what I call, Alan teases me all the time, it's a three-legged stool. It's people, it's process, and systems. And how do you look at all three of those? And all three of those need to be synergistically connected. They relatively need to be equal. So what are the things that people need to look at? And so that's a super important aspect that we want to try to impart some of our knowledge and give people a couple steps to think about, and what are the steps forward making that assessment of what does a buyer think of my business.
Alan?
I'd say from a valuation perspective, obviously an independent certified valuation would say this is what we believe the business is worth. We all know that a business is worth what a willing buyer is willing to pay for it, and a willing seller is willing to sell at an arm's length transaction. So there are things that I think a business owner can focus on, and there are things that are outside his control. From a valuation perspective, there are drivers that are what we call exogenously determined. They're coming from the outside. We have no control over them. We don't have any control over the macro economy, the micro economy. We don't have any control over COVID-19 and its economic impacts. But the things we do have control over are how we run our business, what our financials, the way our financials are put together, and the quality of the financials and profitability. Many business owners, they focus on EBITDA. EBITDA is obviously an important factor, but so is free cash flow, so is a strong balance sheet. So there's a lot of things to be looking at from a valuation perspective.
On that valuation perspective, Marla, I'm sorry, for you, on your perspective, these guys are, business owners that have sold, and so they went through the process, and where you guys were unique is you started your business with exit in mind. And I think many business owners start their business with the hope of staying in business in mind, and then building the business. So Marla, with their perspectives and yours, thoughts?
Yeah. Well, I think, what's so important is, first off, I feel many business owners wait too long to get that first valuation. I don't mean to make this sound like that they're doing something wrong, because I don't think they understand the process or the need to have a valuation earlier in your business. So one of the first things is getting a valuation, which is different than just a back of the envelope valuation. So there's different types of valuations. And so get a certified valuation that's done by Allen, who is certified to be able to do that, and then have a benchmark. So then you know where you're at, so that you have something you're working towards. And then you bring in someone like Jim, to help you with that strategic roadmap on how you're going to, grow your business, scale your business the right way. That was something that Jim and Allen both did from day one with their business that we worked with them to sell back in 2019. That was what was so incredibly impressive about their business. It stood out from hundreds of businesses that we see. We talk, Jim and Allen probably don't know this, but Jason and I talk about their business with our internal team often because yes, right? And that's why we're here, because we want business owners to do this, because from day one, they had the mindset of, we are going to do the right things from the beginning around people, process, and systems to set our business up for success. And because they did that, when they had a life event that triggered them needing to sell, they were still able to control that sales process. So that's my pitch on why I'm here and why I'm representing, working with Jim and Allen, because of the importance around that. That's how a buyer looks at a business.
Allen, I have a question for you. So let's say we have the same business, same industry across the United States, let's say. Would that business value, nuts and bolts maker, would there be a bell curve on the valuations of those businesses? If you had from California to New York, do they all basically sell for the same multiples, or are there variables that you observe?
Yeah, there's so many variables. There's geographical location, of course, and there's local economies, different tax rates. What a business is selling for in California is not going to be the same as what it's selling for in Montana, all things being equal. There is a lot of variability, and I just say that as Marla pointed out, getting a benchmark for one's business is a very important thing to do, because it does create that starting point, and then you can measure. Of course, anything that doesn't get measured doesn't get achieved, and you can measure your success going forward.
Yeah, what I was thinking of is, you've got some with lots of skill sets in there at the far right-hand side, better side of the bell curve, and the folks that don't have the policies, procedures, and all that in place are on the lower end of the bell curve, which brings me to you, Jim. So you've got the similar industries and businesses, and you look at Allen's valuation for the business, and you go, well, there's that blue thing, red thing, and green thing that's very obvious to you that may not be obvious to the business owner. So if you're looking at one of Allen's valuations of a business, and the guy goes, I know I'm going to be exiting in X number of years, what types of things might you look at from a valuation that's done to start trying to develop a plan to move them to the right-hand side of the bell curve?
Well, sure. It's there are multiple ways to look at a value of a company, which Allen will get into. But there's the discounted cash flow. My favorite methodology, discounted cash flow. How much cash does this business produce? Buyers want to have free cash flow so they can get return on investment. So that's probably the first thing I look at is what is the free cash flow of the business. Also looking at EBITDA. EBITDA is another thing. EBITDA is another factor that is a large driver. People need to focus on that. Some people look at a business and say, it's a multiple of EBITDA, and that's what I'm going to pay for it. The equity on a balance sheet. How much equity do I have on a balance sheet? I always tease all my clients that that's their number one scorecard. What's the equity on my balance sheet? So how much have I retained over years? That's another thing we look at. And, then when looking at market comparables, I always say, there's a reason why there's market comparables, why people are doing what they're doing. And they're always saying, well, why would X company get more than I would? Well, then it's an eternal focus on what drives value. And we'll get into this later, but it's all about maximum value of people, process, and systems. And because a buyer wants to come in and say, I don't want to have to pay any more than I have to, because if I've got great people, great process, and great systems, then I've got something to work with. I've got to get return on investment. I have to get there. And I've got to get a company that gives me free cash flow, gives me profitability. And so that's what folks are working on. So if I'm advising my clients, I'm talking about those things first at kind of the macro level before we start getting into the weeds.
Allen, and on the appraisals, most of the world's familiar with the real estate appraisal. Your comps in your neighborhood are X and your house is worth whatever. For you for the business owner, what types of appraisals should they be thinking about, and what are the functions of those appraisals?
Well, for the business, oftentimes what happens is if the business owns real estate, then you want to kind of disaggregate those and you look at the real estate separately. That's typically, real estate is held separately and the operating company is held separately as entities. We would presuppose that that's the case for a business. Real estate appraisals, as you say, is heavily based on comps. There is a capitalization record or method that real estate appraisals will sometimes use, and for commercial retail space and whatnot. But on the business side, it's I would say it's a bit more in depth. There's we are governed by certain rules with revenue rulings. From the IRS, we're governed by USPAP standards, and we're also governed by professional associations like NACFA and ASA and ISBA. These are the organizations that govern our industry, and they are the ones that create the standards that we have to abide by. Generally, there are three approaches to value. It's going to be an asset approach, an income approach, and a market approach. What Jim was mentioning a moment ago on those comps, that's a market approach. You're comparing yourself to other companies in the market, other transactions that have occurred. Sometimes it's a public market where you have to make certain adjustments for a privately held company, and sometimes they're private transactions. The income approach is what Jim was referring to when he was talking about the discounted cash flow method. And that is, by the way, for many purposes, that is the preferred method of valuation. And it's a method that the courts have oftentimes gravitated towards in certain cases. Now, not in marital dissolutions. Those are typically an excess of earning type method, which is an asset method. But those are the approaches, and each approach has methods underneath it. And each one of them have to be looked at. We're required by our professional standards to look at each of those approaches and make some professional judgments of which approach to go with or to weight those approaches.
Mm-hmm. Marla, you have a business owner that reaches out to Raincatcher and says, we'd like to engage you to market our company, and I have this appraisal. Mm-hmm. And you kind of go, this is what my company is worth. Kind of thing. Well, for you, as you look through, like I get an appraisal for a piece of real estate, and just like you guys said, yeah, that's nice. It will sell for what somebody will pay for it, not what it's appraised for necessarily. So for you, how do you view or use a certified appraisal when you're talking to a business owner?
Yeah. Well, it makes our job easier as a broker if we have a certified valuation versus, just an opinion of value. I think buyers are more inclined to accept a certified valuation. There's so many different methodologies for valuing a business, and depending on the geographic location, the industry, the size of the business, they're all factors that influence a valuation. So it makes our job a lot easier when we have somebody like Allen that's endorsed, this is what the business is worth. I had a question that I wanted to ask Allen, and I bet this is a question that other owners are wondering. We already know that there's different ways to value a business, and we talked about kind of rule of thumb, using the income approach. Is there anything that helps you to put together that valuation, anything the business owner can put together ahead of time that would help you to have a more reliable valuation, to present to them?
Yeah, well, first and foremost is a good solid set of books that make sense.
We laugh, but I'm not.
So what does that mean,
Okay.
solid set of books? What does that mean?
Well, we all laughed when he said that because, gosh, there's sometimes where it's like, listen, I understand that you didn't know what you didn't know. We need to set you up with a bookkeeper. Jim?
I got it.
A lot of our job is making sense of those books in what we call recasting them. We recast the financials to try to make them relevant to what we're doing, but also to make them, coherent. sometimes there's just there's so many missing pieces. But the typical PBC or provided by client list typically comes with set of financials. We try to go back 5 years if they've got them. Balance sheet, income statement, certainly statement of cash flows if they've got it, and then governing documents. We need articles and bylaws and management operating agreements, partnership agreements, buy-sell agreements, those kinds of things. That gets us started. We a lot of us is kind of getting into process. I don't want to get into the weeds too much, but oftentimes we are relying. Not oftentimes, we are always relying on not only those documents and income tax returns, but we are relying on management testimony, if you will, the management interview. So when we go to management and we ask them questions about their business and what's going on in the future and what sort of assumptions do you have, that's a big piece of it. And then we have to sort of gauge that, and make sure it passes the sniff test and that it's reasonable.
That's great. I think that's important, because there's business owners oftentimes don't understand how much work goes into giving a proper valuation. I mean, it's very common. Both of you have seen this. Bob, I'm sure you've seen this too, of tax returns not even close to the financials that they presented. And so, usually there's an explanation, and sometimes it's just that the CPA hasn't made their adjusting entries. But there's a lot of work that goes into having that conversation with the owner to get it right. So they can pay for a valuation that you're kind of delivering it to them going, okay, well, based upon what you told me, this is what I have. So, but they have to participate in the process, right?
Right.
Yeah.
Participate in the process, and that participation in the process can get very hairy sometimes, depending on what the circumstances are. We do valuations for marital dissolutions and for litigation purposes and for shareholder disputes. And in those cases, everybody's got an agenda. And so, you get, in some cases, maybe a husband who owns a business and the wife is trying to get the valuation done for marital dissolution. And we're not always getting cooperation on all sides to get all the accurate information. So when we're not auditors, we don't audit the books. We're not making any assumptions or making any comments about whether they're GAAP compliant or what the state of the financials are and the information we're getting. But we do use professional judgment to assess whether we're being told is reasonable or not.
Marla, do you think that the people selling their businesses understand that there's more than one type of buyer? No, I don't. And I think that's where it's important for the business broker that they're working with to explain that to them. I don't think most of them are going to understand the process in general just because they've never done it before, and so that is a big part. That valuation plays a big part into the type of buyer and attracting multiple buyers and all the above. Because you've got the financial buyer, and then you've got the strategic buyer.
Mm-hmm.
And what struck me is you guys were talking from the previous episode where we were talking about the procedures, and all I could think about when you're talking about your company is they can scale that. They can apply that process to their other company. They can import all the stuff that you guys did extremely well and putting the company together. So it would seem like to me a strategic buyer would view that differently than perhaps a financial buyer.
Yeah, absolutely. I think there's an overall, and I'd love Jim to add to this. I mean, my experience, even as an accountant is, there's and coming from the perspective of a buyer, that there's different ways, and I'm going to look at one business versus another business, but there is an overall general rule of thumb on the drivers that you're looking at. I'm probably not going to buy a business, period, that isn't going to grow or doesn't, isn't completely owner dependent. So I think there's kind of a general rule of thumb across all buyer types. Don't you, Jim?
Yeah. Yeah, I think there is. And with, financial buyers, strategic buyers, that's two different ways of looking at things. And, it depends on what you're trying to do. I mean, if there are buyers that are looking for value, looking for just a value that they'll bring in their own kind of people, process, and systems. I see that a lot. I've got some clients that's what they want to do. They're just looking for something that's low value that they can take and run with and bring it into the fold with a like kind group of companies like in construction. There are others that want to come in and buy a company that is ready to go, that they just want to be on the board, or they just want to work on the business instead of in the business. They want the company to run itself, and that's very advantageous for a seller. I mean, if you've got a business that's ready to go, that has, people, process, and systems ready to go, that can attract some premium value. And so, there's other ways to do that. If you look at a PE company, a lot of PE companies just want to buy companies that don't care what you've got. They'll just roll you into their system and give you your accounting system, your leadership, your board, that kind of thing. And so that's a totally different sell. I mean, for a buyer, if you have to be careful on who's your audience, what kind of buyer am I going to sell to? That's a critical point for a seller, is what kind of buyer do I want to sell to? Figure out who you want to do it, and then go after it. And I think that's critical as well.
Yeah.
I as we talk about this, for the business owner that's listening, my thoughts on sequence: how do I figure out what my business is worth? Then you look at it and they go, it's worth X, and you go, can I move it from this side of the bell curve to that side? If so, Jim, what are the levers I can pull? Alan, you can comment, says, other businesses like yours look like this, but if you can move these following value drivers, you'll get over here, where maybe you go from a C company to a B company, and bringing in the coaches to make that happen, which for, I think, a lot of business owners, there's a concern that the coach is not an investment. They view that as just, I don't think they see the return on investment for bringing those value drivers forward at the end of the day. Can you guys comment on what you see from a company that goes, I'm just going to sell here, or I'm going to bring coaches in and I'm going to really start working on my value drivers? What's your experience?
Well, Alan and I worked in a business, for example, where we did some consulting with an owner. He'd never looked at pricing, never looked at his processes, didn't care about his systems, had a bunch of disparate systems. His people were kind of unorganized, kind of scattered. And, first thing we looked at was pricing. And with about 30 days, we realized that he was leaving $500,000 a year on the table with his current clients. He hadn't raised prices, hadn't negotiated contracts. So right then and there, whatever we charged them, whatever I charged them, it's like, oh yeah, there's some money right there. So there in every phase of every business, there are little nuggets that you can look at to say, how can I get better? So if you have an advisor that's willing to look a little bit deeper rather than just saying, oh, you need to use this system, that system, kind of push towards you. If the person understands your business, understands your end game, your goals, and understands business and how to look at any business, look at the management staff, for example. So if a company's owner dependent, and Marla talks about this ad nauseum all the time, we've got to figure out we got to make a change to that, because you potentially could leave money on the table. And so how do we do that? Well, do we have a management team that's ready to go, could be developed? Is it a 1-year path, 2-year path? Or do we need to have strategic hires? Or maybe, like with some of my clients, we buy companies that have strategically placed management people that can be bringing into the company to put in strategic positions in the company to get away from owner dependence and get a staff that's organized, that follows a strategic plan. So those are examples of what some of the things that Alan and I would do. And I do this on a daily basis, just looking for ways. I always have the lens of the buyer all the time. I always have the lens of the buyer. I'm always thinking about that. And to have an advisor that will give you, will be motivational. Obviously you want that, but be frank with you and say, you know what, of this area, we've got a problem. Here are 3 alternatives. They all have 3 different timelines. They have 3 different costs. and what's best for this company, because no two solutions are the same or can be applied to across all companies. So those are some examples of the kind of help that people need.
Jim, if you were to give one just pick one area that a business owner should start with, what would that be? Where can they start?
The first thing, Marla, and I don't say this because I'm an accountant. The first thing is, they go hand in hand, is financial statements and KPIs. What are my metrics? If you understand those two things, if your financial statements, and a lot of people have poor balance sheets, which that creates doubt on the buyer. So when I help, when I go represent a buyer, the first thing I look at is the balance sheet. If the balance sheet's squared away, and I can get a cash rec, or I can look at the equity, there's no upside down balances. Get your financial statements squared away, and also know, you as an owner, you need to know, just no different than when Allen and I were working with you on our business transaction. What are your metrics? What are your drivers? What are variable costs? What are fixed costs? What's my break-even point? What are the basic block and tackle things that people need to know? And I would start there, because that's the big lift usually. I would say 9 out of 10 companies struggle in those two areas a lot, And I probably look at 200-300 transactions a year, and I would say 90% of them, I always go back to the buyer and say, it looks like their balance sheet's in trouble. Did they ever have an audit? Did they have a review? A lot of times owners don't want to pay for audits and reviews. If I can get a reviewed statement at least, or get an audit,
a quality of earnings review,
quality of earnings review, pay for that. I'm telling you, the quality of earnings review, the lenders love that. I mean, every lender I go to that we're getting an SBA loan or whatever type of loan, they always want quality of earnings review, right? So, and I get those owners and say, well, I'm going to pay $10,000 for a review. Well, that's an insurance policy. That tells your buyer, tells your banker, tells all your partners that somebody independent of you looked at your financial statements and you're ready to go. You're ready to go. Your financial statements are ready to be presented. And I know you, Marla, I bet you struggle with that, trying to get that base model of financials, and how do we project out, and how do you tell the story financially if your financials are erratic year over year?
Alan, as they're talking about these steps. So when you come in to look at a company, what access do you have to these types of documents, quality of earnings review, or reviewed financial statements? Do you see those, or do you request those?
Certainly request them. We rarely do we get everything we ask for. It's just the nature of the business. But we ask for that. We ask for financials, very important. As Jim alluded to, balance sheet. That's something that a lot of business owners sort of ignore. That people focus on the P&L, but the real scorecard of a company is the balance sheet.
Number one.
Say that again. Number one.
The number one thing that 99% of owners don't even look at is their balance sheet, and that's where they get in trouble. Their P&L could be, their profit and loss statement could be just letter perfect.
Yep.
But it creates that doubt. So if somebody hires me as a buyer and I'm doing due diligence, remember, Bob, I'm going to look at your balance sheet, because that tells me what your accounting group's been doing, how you've been carrying yourself financially, and I start asking the questions. I sort of go through the balance sheet, because for a buyer, if I got a squishy balance sheet that I don't trust, I might move on to another deal, which means that deal is not as important to my buyer as maybe another one. When I see a good set of financial statements, I'm intrigued by that. I'm like, oh boy, we've got something good here. Maybe we can rely on. And so, what's the thing both people are trying to get to the end? We're trying to trust the financials. What are the projections? What's the 5-year projection, free cash flow, the whole 9 yards. So pay attention to your balance sheet. Get your
balance sheet should be reconciled to everything. Everything should be reconciled, right?
Yeah.
And an owner wouldn't know that a lot of times. Why would they? That was something that they used to bring up. That, well, I didn't know that. I've never taken an accounting course, but your bookkeeper, your accountant, or your CPA should. And so that's I agree with you. I've seen buyers, to your point, Jim, walk away from the deal because the financial states were in disarray. They didn't trust them. And so they thought, what else is wrong?
This week I looked at for a buyer, looked at the balance sheet. It had so many upside down balances. And then I tried to do a proof of cash, which is a very, that's kind of an entry point to if I can prove out cash and I can get the 1231 bank rec to reconcile, I might keep looking. But I don't go beyond that. I literally do not go beyond that. If it's all, and they can't, because how many years has this been wrong? Especially on a legacy company, it's been around 30 years, and the guy or gal never looked at their balance sheets. Like, oh, I didn't know I had these issues, right? Nothing's reconciled.
Yeah, so it happens all the time.
All the time.
Yeah.
Allen, when you're doing a valuation, do you often find that the business owner protects or understands the value of intellectual property that they develop in their company?
No, they don't. We try to have a discussion about, tangible assets and intangible assets. From the investment world, we call that alpha, right? So it would be, any excess beyond what the tangible assets, a reasonable rate of return for a tangible asset would be. And that is something that is part of the valuation process, is identifying those things and getting that balance sheet recast.
For the business owner, let's say that you have a particular niche, or you have a particular insight, or something that your company's especially design, I don't know. So they've got something going on. It's their special sauce. And for the business owner that has special sauce but hasn't done anything to protect their special sauce, what types of things can you do to protect or develop your intellectual property that would affect a valuation if you came at their front door to do one?
Well, I think from a valuation perspective, we look at it as tangible and intangible assets. We prove that out through the normal processes that we have. As far as protecting IP, I mean, there are ways to go about that. Jim, you may have run across.
I definitely have some comments on this. Yeah.
Yeah. Go ahead. Share your thoughts on it.
Well, I was hired, several years ago to sell a company that had lots of intellectual property, a lot of state of art stuff, and that the big the Lockheed Martins of the world really, really wanted. And so my first year there to represent the seller, which because we knew we were going to sell, is to look at agreements with clients, agreement with vendors, employment agreements. We looked at patents, look at trademarks. That you really try to understand what we've got, and then quantify what you've got. A lot of people do for tax purposes. They do an R&D tax study, and they get the benefit of that, but they don't really even realize what they've got. You spend all that time developing a report to support the IRS R&D tax credit. Well, that's great, but quantify what you've got, because a prospective buyer is going to want to know what that is, and how does that differentiate? How do you differentiate yourself from everybody else that's doing the same thing? And how does that make you very competitive in the marketplace? And why do I want to buy that? Why do I want to buy that? And what value does that? Because it may be kind of an intangible value. I mean, because in an asset deal, you're looking at assets, you're looking at intangibles. As a seller, I want to get maximum intangible value, but beyond maximum I can get for tax purposes and lots of other reasons. So I'm trying to drive that up, because I want the seller to understand, here's what you're getting. Here's my secret sauce. And it means something in the marketplace. Knowing your marketplace, understanding the delivery aspects, all those kind of things. I think sellers need to understand that.
Yeah. How often do you guys see, the two of you, how often do you see trademarks, or service marks? Like, would you say 50%, 20%?
Not my experience, not very much. Not very. Most people forget it. Most people don't even understand. It's funny when I'm on the buying side. As soon as we get that stuff, guess what? The first thing we do We protect our intellectual property. We do all the things that we're supposed to do. It may be a patent. It may be a trademark. It may be a copyright. It may be whatever it is. Well, because we just paid for that. We want to protect that from everybody else, from our competitors and anybody else, because that's what we just bought. That's the value we just bought.
Well, they build their brand and they don't protect it.
Right.
Yeah.
Right.
You know, Alan, I'm the business owner, and I said, I really need to understand where my business is currently. I think I'm going to be trying to exit my business in 8 years. I don't know. That's a good number. And so I need to understand where I'm at. And then I need to take and be able to look at the report that you prepare for me, understand where my deficiencies are, so I can go toward the target that allows me to retire. What type of report would I ask from you? And then once I did that, got it in, you and I sit down together, is it reasonable for me to expect you to go, Bob, there's that blue thing over there that you've just done, that's missing. There's this red thing over here that needs something else. Is that something I should expect from you if I engage you to do that?
Yes, yeah, because when you receive a valuation report, and there are different types, and that's part of your question. For internal ownership transition or exit planning, you typically get a summary level report, which is an unambiguous, unbiased opinion of value that takes all the requirements and puts all the required methodologies that into that report. It'd be different than a calculation where you basically are just putting it into a computer program and spitting out a number, usually a DCF. So that is an important report to get, because it does give you a true sense of value. Now, like Marla, for instance, in Raincatcher, they will produce a calculated value. I don't mean to speak for you, Marla, but I think you come up with a calculated value, which is an estimated value. It's not a certified appraisal. One of the things, the product that Raincatcher uses is a product called Value Builder, and you're referring to those blue levers and the red levers and whatnot. That's a very useful tool that Raincatcher provides that helps the business owner understand what levers he can be pulling or pushing or what have you. The obvious ones, of course, is financial performance, and everybody focuses on financial performance, but you also have to look at a lot of these other areas, such as growth potential, how much concentration you have from your income from a single client or a single group of clients, how much spread you have, monopoly control, the ability for the organization to run without you. That's a very important lever as well, and customer satisfaction. So all those kind of play into it and kind of help you get from the left side of the bell curve over to the right side of the bell curve.
I was just, from the business, and I was thinking of a tool. You kind of, it's like in almost any other, in school, you kind of go, well, Bob, you're in the part of the class that made the top half possible. You go, well, I want to be to the top half of the class. How do I get there? And, here's my grade. And so, I'm looking not just at what you guys bring to the table as I'm going to sell, here it is. I think as a diagnostic tool to start doing discovery, and you go, if I don't have my team built, how do I start to build my team? Fractional CFO to start with, if I don't have one. What are the things I can do today? I've got a cash flow problem, which I think, given the current pandemic issues that we have, if that's not the first thing on their mind, is probably the second thing. And I think about, for the companies that are experiencing cash flow problems, Jim said, I had a great business. I got a cash flow problem. I think I can endure, but I need some help. What types of things might you consider and recommend when you work with a company that's concerned?
Yeah, it's looking at the current ability to forecast cash, looking at the ability to for someone to look at the financials, projections, look at the alignment with the strategic plan. Some people have those folks in place. Most do not. I often say, if you'll allow me to come into your company, and I'll do the fractional CFO stuff, and I'll come alongside the owners and the management team and really get them to think about sustainability and where are we at and where are our metrics, and let's do some comparisons of last month to this month, those kind of things, and really try to understand the business so we can make decisions. So with informed data, informed decision points, you can make those decisions. And what are the alternatives? And I think that's for a strategic advisor, you need somebody that can give you alternatives. It's not just one alternative. Look at the business, understand the business, and say, what if we pivoted it to this, or we did this, or we did this? In the COVID world right now, we've got some companies that are downsizing people, but they're staying the course on what their delivery points are, their people, process, and systems. And when revenue picks back up, it's scalable, Bob. We go back up to where we were. We start adding people. We start producing cash. But you want a business that can go down a little bit and expand, and a business that's not predicated on one or two things to make the business go. Because if you lose a strategic client, for example, that's the worst one. It can really hurt you bad. Recurring revenue, trying to get recurring revenue. I think that's one of the things that I think a lot of buyers like. Get recurring revenues. Find ways to get sustainable revenue that cannot be canceled and terminated at a whim.
I wonder, like the length of contract or durability of contract, or Marla, recently lease issues on the sale of a business. Anyways, you think about, I don't know if the business owner goes, I have all of my contracts and they're coming due next year and they're trying to sell. And you go, might you consider that? And the buyer's going to go, those are all coming due next year. Might that be something to take an approach and consider? And if you're a business owner and you're considering selling at some point, look at your lease agreements. And if if you're just like a pig staring at a football, you kind of go find somebody that knows what to do with that lease contract from a buyer's eyes.
Yeah, Marla, if I could, the number one deal breaker, not the number one, but in the top 5 is assignment of contracts, novation.
Yeah.
You've got to know, because the buyer's going to ask in the first part of due diligence, is your lease contract, is your client contracts, is your employment contracts, are they all assignable? And if you can't assign those things, or they cannot be novated, or it could kill your deal. So I always tell my potential sellers, monitor those things, get an attorney. I've got plenty of attorneys that will look at that will look at your contracts, Bob, and say, oh, yes, here, and make a checklist. Have them ready to go. What are my termination dates, right? And those kind of things. It's super important to a seller.
The thing that strikes me is, as we sit here, I'm sort of an armchair observer. I know just enough to be modestly dangerous. I'm a business owner. I'm an exit planning advisor. And whatnot. But I don't do what you guys do. And and I know enough to ask the questions. And I think so many of the business owners, we talk about it regularly, they don't know what they don't know. Yeah. And it's not that they're bad people, and they're really smart people, and I admire them a lot. But you look at that, and the statistic on business owner transition is grim. It's something like 80% of the businesses that come to market won't transact. And I think about the transition of, since the 2008, 2/3 of all jobs created were created by small business. Mm-hmm. And if those businesses won't transition or stick around, what's going to happen to the job creation since 2008? It's a grim statistic to think of, to contemplate. And so, for the podcast, part of the reason we do these podcasts is try to educate the business listener that's interested. Can we give them a tool? Can we give them an insight? Can we give them a go-to? Marla's got a great company on helping business owners sell. Jim, you guys, you and Allen, our former business partners, successfully sold a business, have successfully run businesses. You guys are out there as really sharp tools, in the toolbox. And the fact that some of the business owners aren't availing themselves of that advantage. I mean, you don't need a huge edge, you need a little edge. And, if you think about, if you can get a little bit, 2% here and 3% here and 4% over there, and you go, quit doing that thing and paying capital, was that feed starve analysis, which part of your business really doesn't deserve the allocation of capital? Well, Dad did that. And you go, well, Dad's dead. Don't do that anymore, kind of thing. Anyways, I'm ranting now because sorry, off on a tangent. It's late and there's too much coffee. But
but your point is relevant. You've nailed it on the head. Because first off, the business owner shouldn't be embarrassed what they don't know.
Exactly.
Please don't be embarrassed. We already know that. We're here to help you. We want to help you. We all care. And then, and the stuff we're telling you is because we've helped hundreds and hundreds of business owners. It's not because we're just so smart. It's because of our experience and what we've done in our lives. And so use that to your advantage. I get so passionate. I mean, I'll stop right here because I want to help these small business owners. And I commend you and Jim and Allen for helping, because you guys are really smart guys, and you could work anywhere, but you choose to work with small business owners because we care, and we want to help you, and we want to help you get through this difficult time. And so I really hope, to your point, Bob, that's what they hear. They've taken little tidbits, and it's always that simple thing, and the light bulb goes on, and they go, oh my gosh, I've heard this before, but it was the way you said it. I hope there's something we said today. The light bulb went off, and now they're going to call us, or on, not off.
Well, there's the business owner that maybe is fighting it and brings in the appropriate coaches and stuff and falls in love with their business all over again. And they go, you know what? I've decided that I'm not going to sell. And furthermore, you know what? I think I'm going to add some more. I'm going to go out and acquire some other. And you think about that, and you kind of go, so the outcome is not necessarily sale.
No, not always. Yeah. No, Bob, if I could add one thing, here's a piece of advice I tell everybody, pick somebody you trust, pick an advisor you like. And I tell people, if you could spend an hour with a really smart person that has a lot of experience and that has your interests at heart, an hour a month, spend an hour a month. Whatever the consulting rate is, and start there. Start the process talking about what are your pain points, and, Alan and I have worked for some great CEOs. They had lots of people they ate lunch with and breakfast with constantly trying to gain knowledge about how do I help my employees, my clients, all the things in my business. And so it's that. Start the education process. Sometimes it takes a while, but that's super important. If I could advise anybody, if I could talk to anybody, I tell people all the time, I don't care if you have a $200,000 a year business or you've got a $100 million business. And then the other thing is too, I see a lot of this, Bob. I hope this is a good takeaway. I come alongside many, many companies that have grown from 15, 20 million now or $100 million companies. And all the while they started with an accounting manager, they had a controller, they had a CFO. I don't compete against their accounting people. I come alongside, I support them and their business owners at the same time to try to give it another set of, another lunchbox that they can pull into and say, what other things can we do? What can we do? Because it's again, if you're talking about if my balance sheet's in trouble, you got to get somebody that's going to give you advice that can get down maybe sometimes in the weeds of your journal entries and how you're booking your accruals to advise you on the strategic plan. Have somebody comes alongside. And I've got multiple clients like that. I've done that. And, I get it all the time. The CFOs always will tell me, or the controllers, the county managers, we're so glad you're here because you're not trying to compete against me. You're here to help me, and you're making my owner smarter that understands what I'm trying to do. I'm trying to make a book accrual entry so I can get my balance sheet right. I'm trying to have enough people to reconcile the cash. And so it's just those little things. If you can think about that, it's not a big lift. 1 hour a month with a good advisor would be great for you. And where do I just get started?
Alan, you're looking across business after business as you come and review and do your work. If you had a piece of advice or a parting piece of advice to that business owner out there what might that be based on what you're seeing now?
I think based on the things that I see and the difficulties that businesses have with recognizing and realizing value is first and foremost, get the trusted business advisors alongside you. The grim predictions that you were talking about a moment ago, that these companies that don't transition, what's the alternative? Like they say, I'm getting old, but it's better than the alternative. And if we don't transition these businesses, oftentimes they just close their doors. There's nobody to take over the business. But without getting into the weeds, but yeah, obviously, strong financials, get a good bookkeeper to get your financials together, get an audit from time to time, get your business valuation so you have a benchmark, and refresh that business valuation as you move forward in the process. Those are some just kind of low-hanging fruit items.
Bob, can I say one more thing?
Please.
I say this all the time when I make presentations or I meet with people. I don't care if you're an owner, you're 25 or 55. Doesn't make a difference to me. Think about a 10-year roadmap for ownership transition and get ready for sale. I mean, if I had 10 years in front of me and I could start planning now in a methodical manner to get to the desire I'm trying to get to, what do I want to be doing both personally and professionally? What's the company doing and what's my financial wealth I'm trying to get to? If you can look that far out and achieve those goals and try to look at that helps you. That helps you think about, helps you with your decision making and your plan overall. It drives that every day. And I've got one or two owners that I started with. They're in their late 30s. Now they're in their late 40s. Now they have lots of opportunities. They've done some internal transition. They could sell the company. They could buy more companies, right? So it's all about creating alternatives and opportunities. You don't want to wake up when you're 65 and say, well, I think it's time to sell the business to my employees or to an outside person. So you got to consider both, and the sooner you start planning, and the sooner it is, and the sooner it'll be better for you. And you create opportunities for yourself, your employees, your family, everybody involved, your clients included.
Don't wait.
Don't wait.
Well, guys, again, as I said before, I've been harassing you guys, and I really appreciate you guys sharing the wisdom of experience, and you've been down the path and taken the lumps along the way to learn what you know, and before I get off here with you guys is to contact information. So, Allen, how do we find you?
So you can reach me at our website, which is currently IBVA.com. We are rebuilding our website, and it's going to be IBVAPros.com. It's India Bravo Victor Alpha.com. I'm on LinkedIn. It's my name with MBA-BCA at the end. My phone number is 303-475-3638. Anybody can call me directly anytime.
All right. Jim?
Sure. JimGilbertCPA.com. Jim at JimGilbertCPA.com is my email address. Phone number 720-212-1715. I'm on LinkedIn as well. And glad to spend time with anybody if they just want to talk through things.
Marla, thanks again for helping me co-host this effort and series. And it's a challenging time, or can be, for some of the business owners. And as we go through and do these episodes, I'm hoping that we all kind of extend a hand somehow or another for some of these other business owners and try to help them along. And I hope this is how they view this. It's a continual effort because, and the side benefit and the best part is I get tutored by really smart people, every episode. So I'm grateful for everybody and their time and contribution. So thanks again, guys, for being on this episode.
Thank you, Bob.
Thank
Marla.
you.
You bet. Take care and have a good 4th of July.